Good day, everyone. In this session, we are going to discuss some important identities in national income account. For this part, we are going to disregard the depreciation, and thus we are going to disregard the difference between the GDP and the net domestic product, as well as the difference between the gross investment and the net investment. We refer simply to investment spending. So we take account that investment is only an investment spending. We also disregard other accounts like the indirect taxes and even the transfer payments. With these conventions in mind, we refer to national income and GDP interchangeably as income or output, because in our circular flow diagram, the model shows that the GDP is equivalent to the total income in the economy, and thus it's actually equivalent to the total spending with the economy. So we assume that in the national income account identity, the income or output is equivalent to the GDP. So let's start our discussion with the simple economy. In a simple economy, as we discussed in the simple circular flow diagram, there are only two sectors. We have the households and the firms. We assume that the households will do the consumption and the investments are for the firms. So we have here the following steps. So first, we again assume the simple economy model wherein our gross domestic product is equivalent to income or the output. So again, here we denote the value of output in our simple economy. When we say simple economy, there's no government nor foreign trade sectors. And we account GDP is equivalent to Y. So here, in the first equation, we have here Y is equivalent to C plus I. Again, we do not account government and foreign trade. So that is why we remove government purchases for goods and services and the net export. So we have only Y is equivalent to C for consumption plus the I for investment or investment spending. So again, in the simple economy or the simple circular flow model, we have only two sectors, like the households, which will do the consumption spending, and the firms, which they spend for investment. So here, so next, we are going to establish a relation among savings, consumption, and the government, not government, the gross domestic product or the Y or the income. So take note, we do not have government sector here. So it's assumed that the people do not pay taxes. So that is why our income is equivalent to the disposable income, which is savings plus the consumption. Of course, here, our income will be intended for present consumption. So we have here consumption, and for the future consumption. So that is why we do savings. So here again, whole of the income is allocated to either consumption or savings because we will not pay taxes because there's no government on this economy. So that's the assumption. So here we can see that Y is equivalent to C plus I and Y is equivalent to savings plus consumption. So that is why we are now on the step 3. So we are going to equate equations 1 and 2. So here, Y is equivalent to C plus I, and this equation is equivalent to S plus C or the savings plus consumption. So here, the left identity. So this is the left identity. It's more on the demand side. And here, it's more on the allocation of income. So basically, here we can say that C plus I is equivalent to savings plus consumption. Now, let's proceed with the fourth. So we are going to reformulate identity 3 by showing that investment is equivalent to savings. So we have here I is equivalent to Y minus C is equivalent to S. So here, arranging this equation 1, no? So if we're going to isolate I, so in isolating I, you have to transfer C on the other side. So it will become Y minus C. So which is this one, right? Another, in terms of savings in the equation 2. In order to isolate the savings or S, we have to transfer this positive C on the other side. So here, it will become negative C. So Y minus C. So which is also equivalent to this. So here, we can now say that investment is equivalent to savings. Another formula, considering these three, you just simply have this, no? You just simply have this. C plus I is equivalent to S plus C. So you are going to isolate I here, for example. So you have here S plus C. So you just simply copy this one. And this will be transferred on the other side. So it will become negative C. So this will become 0. So now the remaining term here is only I and the S. So I hope that's clear, because again, this will become 0 because C minus C is actually 0. So the only remaining here is I is equivalent to savings. So at this equation, in reformulating the identity 3, we show here that investment is equivalent to savings. So what you save will be used for investment, or even the investment comes from your savings. So that is why they are equal. And this is only true for a simple economy. So I hope that's clear. Now we are done with the simple economy. So at this time, we are going to reintroduce the government and the foreign trade. So we are going now to include government sector as proxied by the government purchases for goods and services, and the foreign trade, which proxied by the net exports. So we are going to include here the exports and the import, as well as the taxes, because again, the government imposed tax, no, to support their projects or programs for public welfare. So here, let's begin with the step 5. So here we're going to insert government spending and foreign trade using net exports in the national income identity of a simple economy. In a simple economy, we have only Y is equivalent to C plus I. Now, we're going to add the G for government spending for goods and services, which proxied by the government sector, and the net exports for the foreign trade. Again, net exports is export minus import. So given this fundamental national income identity, so we have also to derive very important relation between the output and disposable income. Again, when we say disposable income, this is now your income after the tax has been deducted. So it's actually the after income tax. So here we have this disposable income as denoted by YD is equivalent to Y, which is our income, the national income, plus the TR. The TR here is your transfer payment. The TR here, or the transfer payment, is being added because if the government sends money or gives money to the household, so that in a form of transfer payment, so that money will serve as income for the additional money for the household that will be used for consumption, right? So the household will be using that money from the transfer payment for either consumption or even savings. No? So there would be a part of that TR that will be allocated for consumption and even part of that TR for savings. So that is why we add the whole TR here. And we deduct tax because, of course, there is now government intervention, so the government will impose tax. And again, we're talking about disposable income. And here, we know that the disposable income is the net income after tax. So that is why we deducted tax here. So on the other hand, this is the other formula, no? We have the alternative formula in a sense that we are going to use our disposable income. So this is actually the income left after the transfer payment is being added and after the tax is being deducted. So here we will be using our disposable income, of course, for consumption and even for future consumption. So that is why we do savings. So here, therefore, the disposable income is equivalent to savings plus the consumption. Okay, so we have now this identity. So our next step here for the 8th step, we are going to rearrange the identity 6 and the identity 5 or the equation 5 and 6. So we have here, again, why is that the YD here, no? Why is that the TR is now being deducted from the disposable income and the tax is being added in disposable income? Why is that? Because if we are going to isolate Y in the equation 6, if we're going to isolate Y here, so you just simply transfer the 2 on the other side, right? So this will become YD. Of course, the positive TR, if you're going to transfer it on the other side, it will become negative TR. While the negative TA, if you're going to transfer on the other side, of course, it will become positive TA. So that is why we have this, right? Now, this is now equivalent to Y. No? So this is the Y for the equation 6. And this is also the Y as we presented in equation 5. So this is more on equation 6 and this is more on the equation 5. No? So here and the other one here. So that one. Okay? So I hope that's clear. Okay, so now let's proceed. So we are going to proceed here. So we put identity 7 into identity 8 yields. So in our identity 7 on the previous slides, we have here YD is equivalent to savings plus consumption. Okay? So in our previous identity, okay, in our previous equation. So here we have the CS here. this is actually our disposable income, because disposable income is also equivalent to consumption plus savings, as mentioned in the equation, equation 7. So here, that is why the YD is being replaced with C plus S. So minus the TR plus the TA, which is equivalent to C plus I plus G plus NX. Now, with some rearrangement, we obtain this equation. So how we arrive on that equation? So we just simply arrive on this equation because what we did actually here is that we isolate savings here and even investment. So if you're going to transfer investment on the other side, of course, it will become negative. So while the negative TR on the other hand, so we have here the negative TR will be transferred on the other side, it will become positive. The TA will be transferred also on the other side, it will become negative. No? And you have simply to copy G plus and X. And also the C here will be transferred here. It will become negative. So basically, this is what happened. So we have here savings and we transfer investment here. So from positive, it will become negative. So we have here the consumption. This is now the existing consumption. But then when we transfer the other consumption, it actually becomes negative C. So C minus C, it will become 0. So we just simply copy the G or other accounts related to government. So here, the negative TR being transferred here will become positive TR. Then we have here the positive TA, it becomes negative TA. So this one is actually what we call the budget deficit. So later I will explain the definition of the budget deficit. And here, we're going to add the net export, where the net export is export minus import. So here, if we're going to arrange this one, so it's actually S minus I is equivalent to G plus TR minus TA, or the budget deficit, plus DNX, which this one is actually equivalent to this equation 10, no? So I hope that's clear. Okay. So here, again, as I've mentioned, the G plus TR minus TA is the government budget deficit, and the budget deficit is a negative budget surplus. Budget deficit happens when the government spending is higher than the taxes earned by the government. So, however, when we say budget surplus, so here, TA minus the G, which is the government purchases for goods and services, plus the TR. So here, this equation is actually the budget surplus, indicating that the taxes that the government earned is actually higher than the total government expenditure, which includes government spending for goods and services and the transfer payments. So we have now here G plus TR is actually the total government expenditure. Of course, the G is the government purchases of goods and services. Again, the government spends money. And also the TR, the government still spends money, but then there's no goods and services involved. So that's it. So therefore, we have this, the identity 10 can be arranged to formulate a formula for savings. So on the formula for savings, I just simply transferred the investment on the other side, or or simply here, the investment on this side. Of course, this is negative, so it will become positive. So that is why we have positive I here, plus the budget deficit, plus the net export. On the other hand, if we're going to consider the formula for investment, national investment, so I just simply isolate the investment on the other side to make it positive. Like here, so I transferred the investment on the other side, while this G plus TR minus TA were transferred on the other side. So this is how it goes here. So I'm going to, this is actually the solution, no, for formula for investment. So here we have S minus I is equivalent to G plus TR minus TA plus NX. So what I did is I simply isolate I on this side. So of course, the I here will become positive. Then we have here, copy the savings. Then here, the G plus TR minus TA is actually transferred on the other side. Of course, they will become negative. So negative parenthesis G plus TR minus TA. Then also I transferred net export here. So it becomes net export. So here it is equivalent to investment. So if we're going to have it here, S, negative times positive G, it will become negative G. Negative times positive TR, it will be also become negative TR. Negative times negative TA, so it will become positive TA because negative times negative positive. Then we copy the NX. So this is now the value for the formula of investment. So this is now the formula for the investment. So I hope all of this are clear. So this is now no more on the, we can say that when we introduce government and foreign trade, we notice that they have yield different formula. Unlike with the simple economy wherein investment is equivalent to savings. Here, it's not, because here, the budget deficit and the trade surplus, or like as indicated by the positive net exports, affects how savings is equated with the investment. So given that there's government sector and the foreign trade sector. Okay, so let's apply what we learned by simply answering this example. So consider the following economy. So we're going to compute the following: the net exports, national income, government budget deficit, total government expenditure, disposable income, and the value of savings. We will not find investment because investment is already given. Okay, so here, first, let's solve for the net export. So again, the net export is export minus the import. So here we have export, which is 125 minus 75. So here we have 50. Now 50 million pesos. So this is now our net export. So here our net export is positive. So this indicates trade surplus. But if the net export is negative, it's actually trade deficit, indicating that imports are higher than exports. So here the net export is positive, indicating trade surplus, considering that export exports are higher than the imports. Now, let's proceed with the national income. So again, the national income is denoted by the GDP, wherein GDP is equivalent to C plus I plus G plus the NX. So we have here consumption expenditure. This is our C. The I here is our private domestic investment. And the government spending on goods and services is actually the G. Then we have already here the net export. So here the C, we have 1,000 plus the I, 650, plus the government spending on goods and services, we have 300, then plus 50. So our GDP is actually equivalent to 2,000. Okay, so that's the value of our national income. Now, let's proceed with the budget deficit. Again, the budget deficit or the BD is equivalent to government purchases on goods and services plus the total transfer payment rather, plus a transfer payment minus the taxes. So on this given, our government spending of goods and services is 300 plus the transfer payments. We have here 150 minus the taxes, 200. So our budget deficit here is 250. So it's deficit, budget deficit, because as you notice, the total government expenditure as measured by G plus TR, which is equivalent to 450, is higher than the taxes earned by the government. So speaking of total government expenditure, so here we just simply add government purchases on goods and services and the transfer payment. So transfer payment is included in the total government expenditure because again, the government spends money. But then in the transfer payment, it doesn't include goods and services. So it does not included in the GDP because there's no involvement of producing goods and services. So we have here G. So our G is 300. Then our TR here is 150. So our total government expenditure here is 450. Now, let's proceed with the disposable income. So the disposable income can be derived by simply deducting and adding, no? Like first you have to add the income, no, and the transfer payments. So you have here transfer payments, but you deduct the taxes. So given that there's no savings here, and we have to find the value of savings, so we will be using this formula. So the income, we already solved for the income, which is 2,000, that is your GDP, plus the TR, that is 150, minus the taxes, so that is 200. So 2,000 plus 150. So we have here 2,000 plus 150. We have here 2,150 minus 200. So we have here now the disposable income is 1,950. Okay? Your disposable income can be used for savings or even for consumption. Now, for savings, if we're going to use the formula for savings based on what we derived in the, of course, in the previous slide. Okay, so we have here the investment, okay, the the savings is equivalent to investment plus the budget deficit. So we have here G plus TR minus TA. So this is already the budget deficit. We already derived it. Plus the net export. So here our savings is equivalent to investment. So we have here 650 plus the G. So we have here 300 plus 150 minus 200. Then the net export here is 50. So computing the budget deficit, so we have here savings is equivalent to 650 plus the budget deficit, which is 250 plus 50. So we have here 950. So this is now the value of our savings. Or we can use another formula. So in another formula, we can say savings is equivalent to Y, the income, the GDP minus the consumption, right? So here, savings is equivalent to the income, which is 2,000. Yeah. Savings, since there's a transfer payment here, we also add transfer payment. The savings, sorry, the Y here should be the disposable income. I'm sorry for that. So we have already computed the disposable income. So here, the savings, the disposable income is 1,950 minus the consumption, which is 1,000. So our savings is still 950. So they're actually equal. Okay, so you can use the formula where savings is equivalent to disposable income minus consumption, or you can also use this formula that we derived using the national income identity. So I hope that you learned something about the national income identity in a simple economy, and even in considering the other sectors like the government and the foreign trade sectors. So I hope you learned from this lesson, and that concludes my topic today. So once again, a pleasant day to everyone.